Hey there, friends and followers. While we are seeing home prices cool down and regulate, one item that is still plaguing home buyers is, of course, mortgage interest rates. To combat this, mortgage lenders have come up with a couple different approaches to not only keep payments affordable for home buyers, but also keep them buying. We'll go over these approaches and some pros and cons on them. Stay tuned. So yes, as always, welcome back. So it's been suspected that mortgage rates are finally beginning to top out, mainly due to the Consumer Price Index showing that inflation has actually risen less over the last month to month and a half. Where the concern comes in, however, is the spread between mortgage rates and the federal fund rates. Now, it's been said that the gap between the 30-year fixed mortgage rate and the government borrowing rate is much higher today than it has been historically, and if we didn't have this large gap, mortgage rates wouldn't be 7% or more. They would be more so around the mid to high fives. A normal spread would revive the economy, and if inflation further dissipates, then we'd see less anxiety within the financial markets and even lower interest rates. This evening out, while much needed, isn't something that can just happen overnight. So in an effort to get creative, retain consumer confidence, and allow home buyers to maintain the pursuit of home ownership, mortgage lenders have been advocating a couple different tactics to buying a home that may benefit you, with all things considered. First, and probably the one that you've heard the most about, is a rate buydown. Now, when obtaining and molding your mortgage, you actually have the ability to pay points to get your interest rate down to an amount that's hopefully more affordable than what the current fixed rate is. This is a great tactic as you can really maneuver some significant savings with your monthly principal and interest, and in some cases even have the seller of a given property help contribute to paying in and buying down your mortgage interest rate. One thing to keep in consideration with this approach, however, is at what point will the buy down be worth it for you, specifically if you are solely buying down the rate yourself. Looking at something called the break-even point. Because you buy down your rate upfront upon closing, this is essentially gauging the time needed to be spent in the home versus what you are saving in monthly payment to make worth the money put out against the buy down. For example, if you have a $100,000 loan amount, 1 point would be 1%, which is $1,000. Keep in mind, with that payment, it won't be a full percentage deduction on the rate from, say, 6% to 5%, but rather an eighth of a point or a quarter of a point, taking you from a 6% to a 5.75% interest rate. This, of course, can vary by lender to lender. To take it a step further, with that same $100,000 loan amount, let's say that you paid in $1,000 to buy down the rate from a 5% to a 4.75%, taking your monthly principal and interest payment from $536 to $521, a savings of $15. Divide that buy-in of $1,000 by your monthly savings of $15, and it equates out to roughly 66 months, which, divided by 12 months in a year, comes out to 5.5 years in which you would need to be situated in that same home in order to reap the benefits of the buy-down. Because you're paying money upfront to benefit in the long run, it's important to keep this in consideration to know what the break-even point is in an effort to know how long it will take you before you recoup that expense back and start building equity in your new home. If you only plan to reside in the home for a short amount of time, you may want to shy away from buying down any type of rate. Next strategy is an ARM, or an adjustable rate mortgage. Now, this type of mortgage loan is structured exactly like it sounds, an adjustable interest rate over the term of the loan. Now, the rate can increase or decrease based on an economic indicator known as the index. Typically, there are set intervals in which the interest rate will fluctuate up or down. This could be 2 years, 5 years, or 7 years, depending on how your loan is structured. There is usually both an interest rate and a payment cap with these types of loans that will not allow the principal and interest to exceed a certain amount. Now, the most obvious perk to this type of mortgage loan is that you can lock in a low interest rate and benefit from low monthly payments. However, once that time interval passes and the mortgage adjusts, you're going to want to make sure that you can afford the principal and interest at the higher payment, as most times the mortgage loan will adjust higher and not lower. Now, another key detail with this loan type that you're going to want to make sure of is that you have the ability to sell and or refinance to get out of the ARM loan. In some cases, if your home value turns out to be less than what you bought at, resulting in no or negative equity, and your loan is about to adjust, this could really put you in a sticky situation. Also too, if say your credit score isn't where it was at when you made that initial purchase, that of course could affect your ability for the refinance. All in all, these methods are great tools to consider, especially in the current market conditions. However, don't look at these options with tunnel vision. Consider all avenues of your financial situations and the details around your mortgage loan. Of course, you may not understand all the aspects involved, specifically if, for say, you are a first-time homebuyer, but that is what trusted professionals like myself are here to help and guide you along with. Well, there you have it, a couple of home buying strategies to consider for home buyers here in the current market. Now, if you'd like any further information, elaboration, or just have any general questions on this, drop a comment below, reach out to me directly. As always, be sure that you are liking and subscribing to the page to keep up to date with great residential real estate information like this as it's released, or anything regarding the Ocala, Marion County area. As always, thanks for tuning in and checking out the videos. We'll catch you guys on the next.